Welcome back here with Money, Money, Money. And this week we're trying to understand ETFs, a newer investment avenue if you're thinking of equity, but a pretty interesting one nevertheless. We've got Manas Shukla with us in the studio. So Manas, let's continue the conversation. Now that we've understood the concept of an ETF, how it's created, the question is, how do I balance out my portfolio? As you said, you need to do a mix of both active as well as passive investing. What's the right ratio, you think?
As I pointed out, the large cap segment, right, the factor indices are now coming up into the country, which will perform commensurately as good as any large cap product at 150 cost, right? So effectively in the large cap segment, we believe ETF actually makes ground. However, with all due respects, there are a lot of fund managers who actually have a very good stock picking ability, specifically when you talk in terms of the under researched stocks. Right, so when you talk in terms of mid cap or small cap investing, I would bet my money on active management. But when you talk in terms of stocks which are large cap, for which data is available to every fund manager and everybody.
There's nothing new to discover.
Nothing new to discover. So that itself can be constructed easily into an index.
But you know, you did speak about the global trend. It's so true. And for the Indian market, otherwise we keep talking about global ETF money that will come in, or if ETFs pull out, then we're very worried about how much our benchmark indices will fall. But again, sampling data right now, and again for viewers' reference, this is some data that we've got as of the entire year, the fiscal year FY16. The total inflows into ETFs, that's not gold ETFs, ETFs beyond gold, stood at around 8,724 crore rupees. And that's a huge improvement compared to a total inflow of just around 2,200 that we saw in the previous financial year, FY15. Why is this surge happening? We also hear that increasingly the EPFO will be investing more. What can we expect in the ETF market?
So Ruby, just pointing it out in a different framework, you have invested into an ETF whether you know it or not. So
my provident fund money is already going into ETFs.
So effectively, I mean, you know it or not, it is going into an ETF, and that is the best thing which has happened in last year. So there are new avenues which the government is opening up, specifically after the CPSE happened, which was a disinvestment ETF. Then insurance segment was allowed to invest into ETF. Provident funds are allowed to invest into ETF last year, and that is the way it happens globally. I mean, specifically talking about Asia itself, the biggest ETF change which happened in Asia was a product called Hong Kong Tracker, which is basically a disinvestment ETF done by China after taking over Hong Kong. So that is the way it is. We personally believe that with factor indices coming in, with all awareness created by people like you and me, it would actually be forming part of a majority of a portfolio, maybe through a direct route, which is basically you and me going to the exchange or investing,
and buying,
or through a package, which is basically through provident fund, through portfolio managers, through other media.
So final hygiene questions then. What is the right time duration to hold? I mean, for large cap stocks, typically the thumb rule is hold for the long term, you will make good returns. Does that apply to an ETF as well, ETF holdings? And also, what about the taxation element? Would the product enjoy the same kind of exemption from capital gains tax, or is there any difference between, you know, holding other mutual funds or holding an ETF?
I'll answer the second question first. There is no tax difference.
Okay.
It is the same whether it is an active mutual fund, whether it is a ETF.
So no long-term capital gains issues, nothing of that sort whatsoever.
Post 1 year.
Of course, post 1 year.
Yeah.
Yes.
So it is the same whether it is a stock, it is a ETF, it is a mutual fund. However, the difference actually which lies out here is, in case of an ETF, there is no exit barrier. If you want to move out tomorrow, you can move out. But as is said, for equity, you have to hold the stocks for over a period of time, right? Normally, I mean, I would suggest hold it as you hold like a normal mutual fund, normal active mutual fund.
So that's when you'll hope to see a better NAV value and that appreciation to come in.
Exactly. But since it's a trading product, I can also trade it intraday. There's nobody stops me doing it. I have the live price. At some point of time, if I see that, I mean, for example, an RBI policy day, and I think, okay, the market may go down, I can sell it.
Okay, well, interesting product, and thank you so much for explaining it to us now that we are more enlightened and informed. Let's see how ETFs do in the coming years. Manas, thank you so much for joining in on the show. Well, that's where we'll take your leave on this week's edition of Money, Money, Money. But of course, remember to reach out to us. Any feedback, queries, comments, our email ID is on the screen. Until next week.